YouTube, this is the Working Investor. In this video, we're going to talk about the difference between compounding your interest weekly versus monthly, because nowadays we have these round hill funds like XDTE, QDTE, and soon to come out RDTE. Actually, I think I mentioned it's coming out on the 3rd. I think actually I saw, I think it was the 4th actually of September. But it's coming out basically the first week of September. So yeah, with these funds, let's calculate to see the difference between 52 contributing contributions that it gets to compound 52 times a year versus 12 times a year. So there's a link over here. There's so many different calculators out there. This is a good one I found, which is called the calculator site. I'll post a link in the description. So let's say you start off with 10K, so $10,000. Let's say the interest rate is about, let's say the dividend return is about 30% yearly. And let's say you want to compound it for, let's say, 10 years or 5 years, because we don't want to become wheelchair rich. We need to hurry up and get rich quick, right? Let's say we make no contributions. And here we see over here, it says monthly, right? So monthly, which is, that's how fast it's compounding. So it's 12 contributions a year. If you calculate it based on 10K, I like how it breaks it down. So it says like, your 10,000 will yield 33,997. So just under 34K of interest, or if you want to call it dividends. And then it says like, your compounder rate, because you're compounding it instead of 30% return in distributions, you're getting actually you're getting 34.49%. And then I like how they break it down, that how fast it takes for your investment to double. So it says here it'll double in 2 years and 5 months. So look carefully at these numbers, because when you compound it weekly, it does increase it, but ever so slightly. So we're talking the compounder rate of 34.49%, and we're talking about interest of just under $3 or $2.10 below 34K. And let's just do the same thing. We're just going to go here and you go to weekly. So it's 52 contributions. And instead of, so you see here, it's like a little over $600 more over a 5-year period. So just a hair more. And then the compounder rate is just a little bit more. So 34.87 versus 34.49. So it's like 30, it's like 30 plus basis points higher. I mean, a lot of times when people do these treasury products, people love to get an extra little bit of basis points higher on your return. So it makes a difference. In 5 years, it does make some difference. I don't think it makes a tremendous difference in a small time frame. I'm sure like larger time frames, if you go out more years out, it will make a higher difference, a larger difference in magnitude, but it makes a difference. I just wanted to point that out. I also wanted to talk about, let's talk about BITO. Interesting. BITO is a futures ETF, and they came out with their distributions. They just announced recently. It's coming out over here if you go to the bottom. And I actually thought that they were going to go down on the distributions like significantly, because you can see here like at some point it was 35 cents, 72 cents if you go back in February, but surprisingly enough it's still over $1, so it's $1.20 coming up. Unfortunately it's a little too late now to get in, because the ex-dividend date is already on the 3rd, and that's when but I have 100 shares, so it's exciting to make a little bit of money, and I know that some people I'm in touch with, they're like very into, you need to have 1,000 shares of BITO to get a nice 1K coming in a month. So again, it looks pretty cool. So I was just wanted to see how it goes, see if I want to increase my holdings or not. And then just going to go over my portfolio a little bit, what's going on with the strategy, what's going on over here. So of course you see a little change of portfolio, well, paycheck contribution, and also $5,000 that I had in a treasury product, which I rolled in. I do have some buying power here I can use. I'm not using too much margin. I'm using about under 7 grand of margin. The first $1,000 is already included part of the Robinhood Gold. I think at some point they had like a $2,000 included promotion, but now it's about $1,000 is included already, part of the $5 fee. So these are some options that I have. So when it comes to, we'll get today more into the high yield dividend ETFs. So basically, every like other week there's another fund coming out, and I don't want to keep jumping around from fund to fund. So I find the best funds that I could think of, that I could find, do my research on it, and I start off with an allocation. If it's a single, especially if it's a single stock ETF fund, I start off with like 5 grand, which is a little more than 5% of my holding. And then if it's like something like the round hill products, I've been going up like 10,000, so 10,000 into chunks in there. So I have 5,000 in AMZ, which is high yield dividend ETF by, on Amazon by YieldMax. 5,000 I put into Phoebe, which is Meta, Facebook. I have 5,000 in NVIDIA, which I have 3 sandwiches. I have the NVIDIA sandwich. You can see here the Tesla sandwich. You can see here the Coney sandwich. So basically I'm hedging, and I'm using inverses, and I've played each of these sandwiches 60-40, 60% bullish, 40% bearish, so 60% in long, and 40% in the short ETFs, and each side pays a very hefty dividend distribution. So basically, my whole idea is just to try to keep the NAV relatively stable, but still get a nice payout, and just running these 3 experiments. So I have the 5,000 in NVIDIA, split between NVIDIA and its inverse, which is dips. 5,000 in Tesla, which is Tesla and crash. And 5,000 in Coney, which is Coney and fiat. And here I have the round hill products, which I started off, my allocation I put in is 10,000 in XDTE, 10,000 in QDTE, and soon to come will be, my goal would be 10,000 in RDTE. I just hope, I don't want to jump in blindly. I'm assuming, and I don't want to, they say assume is ASS, you and me, that RDTE will perform similar to these other products, which we all been pretty impressed with recently. I would imagine that it would, I'm hoping that RDTE will have the NAV stability of XDTE and the dividend premium of the QDTE. That would be awesome, but we'll see how that performs. We'll see, so I'm not sure if I'll jump right in as chunk or kind of like ease my way in there, build it up, see, kind of wait and see type of thing. I have my 5,000 in SPYT. SPYT, of course, is not the highest. It's actually the lowest dividend payer, but I look at it because it's like I mentioned, like it's NAV. It's pretty much historically been NAV stable. It's as stable as a table, maybe a little bit of a bent table, but almost stable as a table. But again, it only has a few months of history, but it did demonstrate relative stability in a dip-ish. It did fall somewhat. So actually, I was thinking about it the other day. And I was trying to see, like, if you go back 3 months and you want to see, like, what percent it dipped, it looks like it dipped 7% down. And if you want to compare that to SPY, which is its underlying, or actually, I think they use IVV, but nonetheless, or some other SPY derivative, based fund, but just it's, they're all correlated. So let's say if you go, yeah, it looks like SPY actually, SPY actually held up. It held up, I would say, better than it. So it kind of contradicts my thesis, if it really did, because you see it's down like 1% or so, I guess. And then SPYT was down like 6-7%. So maybe my thesis, I'm open-minded. I'm not married to these things, but I feel like it's stable, but I guess maybe I could be wrong. Maybe it's not the right move. See how it's down a greater percent, 6%. Theoretically, because it's cover call ETFs, it should be, there should be, it's not going in naked into these funds. There's a term in options called going in naked, and it's something called undefined risk and defined risk. I would imagine it's more of like a defined risk. But yeah, but it did recover pretty quickly, but so did everything else. So I'm kind of, that's why I don't want to go in more than 5,000 into it. I kind of want to give it a chance to do its thing. I'm building up FEPI right now to 5,000. Kind of rolling everything I can into it, into FEPI, just to get that up to $5,000, or roughly $5,000, which is like 100 shares. TNA is where I'm doing a strategy right now on. I'm doing basically doing I'm doing a strangle on it. The put side was already profitable, so I took the put off for some profit, and I still have the call in there, call premium in there. Basically gonna get $76 in premium in about a week, which is about almost a 2% return on my money in a week. So it's pretty good. I'm trying to find a little bit of extra alpha in there. Interesting though, I know that because this is a leverage product, and I remember reading about it, and I saw also in the interview that I think Jablonski on the interview, she's one of the Defiance managers. She was mentioning to the coach that triple leverage products are now like grandfathered in, and there's a lot of funds that you could do double leverage or 1.5 leverage, but triple leverage is already grandfathered in. There aren't any more funds in the USA that could do triple leverage. I'm not sure. I think I saw somewhere in the foreign countries, other countries out of America, I think there's some crazy products like 5 leverage. I have to look into those. But so basically, TNA is a triple leverage Russell 2000. There aren't going to be any new funds. But I heard with Yield Boost, I heard that they're coming out, and again, I heard they're going to be doing like leverage products. I'm not sure if they're going to be trading triple leverage products, but I know for sure, I'm quite certain they're doing 2x leverage products. So we'll see, because it's double because it's 2x leverage, it's double the implied volatility, hence double the premium option potential, hence double the dividend, like greater dividends. And BITO actually really got into it to get my shares call away. I kind of got into an in-the-money cover call with BITO. And of course, Bitcoin went down, so did its correlated futures. But just by holding it, so like my cost basis for it is $20.08. I've already received some premium a couple times too. I've gotten 2 different weeks of premium in there. And now, because it's fallen so far, I'm only getting like 1%. Well, that's a put. So here, I have another call over here. I'm actually doing a strangle on it. So I have a call. Unfortunately, I couldn't do the weekly because I had to make some, to get like 1% return, I had to do a few weeks out, like 3 weeks out or so. So I do have like at least 1% return in 3 weeks, which is something while I'm holding it. Plus, I got the 2 different cycles of premium in there. Plus, now you're seeing I'm getting $1.20. $1.20, which is 100, times 100 shares, is $120. But if you look about the cost basis, that's a 6%, whopping 6% return in pretty much a month, which is insane. Plus, you see here I have a call that's another 1% return, so I'm getting 7% return a month. Plus, I've gone through 2 cycles of calls, so I have somewhere like between 8 to 9% return, 8 to 9% return in a month in BITO, which is crazy. Think about how fast that would compound, how that would annualize. But this month right now, realized it's going to be around 8 to 9% return this month. I'm down about $100, but I've more than compensated for that, and I'm only down if I sell it. And as a matter of fact, I'm trying to increase my position, so I put on a cash secure put, a $17 cash secure put expiring next week, and it was a $20 credit for that. So that's greater than 1% return in a week. So if it goes down, if I get assigned the shares, great. I have another 100 shares, reduce my cost basis. And so basically I have a covered strangle right now on BITO. So I'm making money on the put, making money on the call, and making money on the distribution of the $1.20. So it's been a pretty juicy profit giving machine with BITO. So yeah, and then this is just Google. Unfortunately, I tell you guys, I initially I was playing the earnings of Google, and I had a 180 cash secure put, which I had to roll down to 170 for a $180 loss. And then I finally got assigned the shares, and basically you can see that I'm down. On paper, I'm down. Because my cost basis is $170, so and right now it's trading at 163, so I'm down like almost $700. So I'm just holding on to Google, but I am selling I'm selling right here a Google. Unfortunately, I had to go a few weeks out. It's kind of like just for a little bit of credit, $58 in credit, a 172 call. I chose the 172 strike price because I had my cost basis is not even 170, because I had a $180 loss. My cost basis is really like 171.8. So that's why I sold the 172 call. I may do a 170 or 172, but ideally I like to do like at least a 170, like at least I want to sell calls at my cost basis. I mean, it's a long-term play, and it is sucking a lot of capital out. So I don't mind at all if I get if I get this called away, and then I could go ahead and buy more high yield dividend ETFs. Plus, I got lots of margin here. Anyways, I hope you guys have a wonderful, wonderful holiday weekend. Just remember the power of compound interest. It's like the eighth wonder of the world. I think I was reading up that Warren Buffett, made 90% of his wealth after the age of 50 because of how crazy compound interest is. And, invest as young as you can, invest as much as you can, because, well, not financial advice, but that's like a known thing. Because, you don't, it's good, and invest in your health, because health is wealth, and you could be 90, and you could be, there are people that are 90 or 100 years old, believe it or not, that are ambulatory and live a rich life and can do exercise and everything. And there are people that are like 30 that are like on death's door. So take care of your health, your longevity, your quality of health, your quality of life, and try to attain wealth while you're young, but at the same time also take care of your body and your health, so you can actually increase the number of years and increase the number of healthy years in your life as much as you can. Anyways, all the best. Take care.